I want to tell you why I am buying oil right now, not because I suddenly turned into an oil permabull, not because I think energy is the only thing that matters, and not because I am trying to make some heroic call that the whole world is about to end next Tuesday. I am buying oil because I think the world is underestimating how serious this supply shock can become if it drags on, and because I think oil is one of the few assets that can actually help protect a broader portfolio if the rest of the market starts choking on the consequences. That is the honest version, not hype, not drama preparation. The source document you gave me started with a very strong instinct. What is happening around the Strait of Hormuz is not normal. That part is absolutely true. The EIA says the strait carried an average of 20.9 million barrels per Dalton Y in the first half of 2025, roughly 20% of global petroleum liquids consumption. Reuters reported on the 29th of April that traffic through the strait had fallen from roughly 125 to 140 ships a day before the war to around 6 in a 24-hour period. That is not noise. That is a choke point being choked. That matters because oil markets do not need perfection to stay calm. They need flow. They need confidence. They need a belief that the next tanker can move, the next cargo can clear, and the next disruption is temporary rather than structural. Once that confidence starts slipping, oil does not behave like a sleepy commodity anymore. It behaves like a stress signal. And right now, it is sending a stress signal. Now, let me clean up the first thing that needs cleaning up. The source transcript spoke in very absolute terms about 12 million barrels per Dalton Y disappearing from supply and called this the largest oil supply shock in history. I understand why that language is attractive. It is simple, it hits hard, but I would rather give you the more useful version. I do not think the intelligent way to frame this is to pretend we know the exact missing barrel count down to the decimal. The intelligent way to frame it is this: a waterway that normally handles about 1/5 of global petroleum liquids is severely disrupted. Traffic is down to a trickle. A major bank like Barclays now models a sustained market deficit of 6.6 million barrels per Dalton Y under prolonged disruption. And the IEA has already documented huge inventory draws outside the Gulf as buyers scramble to replace lost flows. That is more than enough to take seriously. That is the adult version of the bull case, not theatrical certainty, serious imbalance. And imbalance is all oil needs, because the oil market is not a market where you can casually lose millions of barrels and shrug. When supply drops enough in the wrong place at the wrong time, price has to do the rationing. That is the brutal truth. Price is not some decorative line on a chart. Price is the mechanism that tells the world to consume less when there is not enough to go around. That is why I think too many people are still misunderstanding what they are looking at. They think that because oil is not already making new inflation adjusted highs every day, the problem must be manageable. Remember, the current price spike has happened before the full shortage pain has been felt across the whole system. That is a huge difference. The market is reacting to anticipated shortage, not to the final stage of shortage. That is why I keep saying this situation is more dangerous than it looks. When oil first starts moving, it is reacting to fear. When it keeps moving, it starts imposing discipline, and that is where things get ugly. Now let us talk about the Strait of Hormuz itself, because that is really the center of gravity here. A lot of people hear Hormuz and think this is one more geopolitical headline they are supposed to file away and forget. That is a mistake. The Strait of Hormuz is one of the few places on Earth where geography itself can punch the entire global economy in the throat. That is why this matters. Too much volume moves through too little space. And once that channel is constrained, the world does not have a magical duplicate pathway sitting there waiting to absorb the flow. Yes, some barrels can be rerouted. Yes, some pipelines bypass part of the problem. Yes, some exporters can still move some crude, but some is not the same thing as enough. That is the distinction. The source transcript was right to focus on that. The route does not need to be sealed with concrete for the shock to matter. It only needs to become unreliable enough that ships hesitate, insurers reprice, military risk rises, routing becomes inefficient, and buyers start bidding for replacement supply elsewhere. That alone is enough to strain the system. Reuters' recent reporting makes that perfectly clear. On May 5, Reuters said the strait remained effectively blocked despite a pause in U.S. escort operations, and that oil prices were still over $100 on the same day. Reuters also reported that only a second U.S. flagged vessel had managed to transit under heavy protection, which tells you how far from normal this still is. That is not a functioning market. That is a market operating under emergency logic. Now, I want to say something important about inventories, because this is where most people get seduced by giant gross numbers and stop thinking. The source transcript used the figure of 8.4 billion barrels of global inventory and then asked how much of that is actually drawable. I think that is the right question, because in commodity markets, the gross stockpile number is often much less important than the usable stockpile number. Inventory in the wrong place is not the same as inventory in the right place. Government reserves are not the same as commercial working barrels. Oil that needs the wrong refinery configuration is not the same as oil that can instantly plug a shortage where it matters. Floating storage inside the disrupted region is not the same as freely deliverable supply to Asia or Europe. That is why I do not take comfort from giant inventory totals by themselves. The IEA's April 2026 oil market report said global observed inventories fell by 85 million barrels in March. More importantly, stocks outside the Middle East Gulf dropped by 205 million barrels, or about 6.6 million barrels, per Dalton Y as flows through Hormuz were choked off. At the same time, crude and products built up inside the region because limited outlets trapped barrels there. That is exactly the distinction people miss. Inventory can exist and still not save the market if it is trapped, mislocated, or slow to mobilize. That is why I do not need to know whether the immediately available buffer is 800 million barrels, 1.2 billion, or 2 billion to understand the danger. The real issue is not whether the world owns enough crude in aggregate. The real issue is how quickly usable supply can reach the right market in the right form while a critical choke point is under pressure. And that answer is not smoothly, not cheaply, and not fast enough to justify complacency. This is also why I think it is naïve to look at oil holding around $100 to $110 and conclude the market has already fully priced the worst. Case outcome, Barclays just raised its 2026 Brent forecast to $100 and explicitly said that level is not the new equilibrium. It warned that prolonged disruption could push Brent to $110. Reuters also reported Brent briefly hit $126.41 on the 30th of April before settling lower. So the market is already telling you two things at once. First, the shock is real. Second, nobody is confident they know the final clearing price yet. And that second point is incredibly important because if the shock persists, price does not stop at the first scary number people mention on television. Price keeps moving until demand breaks enough to match the new supply reality. That is what a real oil spike does. It destroys demand, not politely, violently, through higher gasoline prices, through freight pressure, through airline costs, through petrochemical input costs, through fertilizer, through food, through inflation psychology. And this is where the oil trade stops being just an oil trade. It becomes a macro trade. Now let us talk about the stock market, because that is the real reason I am willing to own oil here. I am not buying oil because I want to dump everything else I own and become an energy monk. I am buying oil because I do not want to sit there smiling at my long-term positions while a supply shock squeezes inflation higher, knocks out rate, cut expectations, and hits equities all at once. That is the part I think a lot of people miss. An oil position in a moment like this does not need to be a religion. It can be insurance. That is how I think about it. The source transcript said exactly that in a much louder voice. This is not really about making a wild bet on oil. It is about hedging a broader portfolio against a market crash. I think that is the most intelligent part of the whole piece, because if oil keeps climbing from here, it is very unlikely to happen in a vacuum. Higher oil bleeds into inflation. Higher inflation narrows the central bank. Adds room to ease, narrower room to ease pressures valuations. And suddenly the same growth stocks people loved on the way up start feeling much less comfortable. Reuters said on May 1 that some Fed policymakers were already warning the oil shock could require abandoning the central bank's easing bias, and even floated the possibility of hikes if the closure drags on and inflation worsens. Reuters also reported on May 5 that the Fed's rate cut window is narrowing as the conflict lifts energy costs and keeps inflation concerns alive. That matters because markets had spent a long time assuming the next big policy move would eventually be easier money. Oil is one of the few things that can interrupt that fantasy very quickly. If oil is spiking and central banks are trapped, then the market is not living in a clean, bullish environment anymore. It is living in a stagflationary stress environment. And that is exactly the kind of environment where a hedge matters. Now, I want to say something else very clearly. I do not think the correct way to play this is to liquidate every equity position and hide behind crude contracts like a bunker trader. That is not how I think. I still believe in long-term investing. I still believe in owning productive assets. I still believe that selling quality holdings every time the world looks dangerous is a great way to stay poor and emotional. But I also believe in reality. And reality says that this is not a normal environment. This is a supply shock in a market that still has not fully adjusted to what a prolonged Hormuz disruption would mean. That is why I am comfortable using oil as a hedge, not because I want the war to continue, not because I enjoy the idea of higher energy costs crushing people. Quite the opposite. I would rather the conflict de-escalate, the strait normalize, and the rest of my portfolio keep grinding higher. That is the outcome I would emotionally prefer. But I am not in the market to emotionally prefer things. I am in the market to prepare for what can actually happen. And this can actually happen. Now let us talk about the bearish case, because if you cannot articulate the other side, you do not understand your own trade. The biggest risk to being long oil here is de-escalation. If a real durable agreement emerges, if passage through Hormuz meaningfully normalizes, if insurance and shipping conditions relax, and if trapped barrels start flowing again, then a large chunk of the fear premium in oil can come back out. That is the obvious risk. And it is real. Reuters reported on May 5 that Trump had paused efforts to escort ships, citing progress in talks, and oil promptly fell for a second day. That is exactly how this trade can hurt you. De-escalation does not need to solve everything. It only needs to make the market believe the worst is less likely. That is why I would never call this a risk-free trade. It is not. It is a conditional trade tied to the persistence of disruption. And because it is conditional, I think position sizing matters tremendously. This is not something I would build my entire financial future around. This is something I would use to offset what the rest of my book might suffer if the oil shock intensifies. That is a very different posture. Now let us go back to the inventories one more time, because there is a reason I think this matters more than people currently appreciate. The panic in oil does not start when the very last barrel is gone. It starts when the market begins to doubt the buffer. That is the point. Once buyers start worrying that spare barrels are shrinking too quickly, or that what remains is too slow to mobilize, or too badly located, or too politically locked up, then price can jump before physical depletion becomes obvious. That is how commodity markets punish complacency. Not after the shelves are empty, when the shelves look like they might become empty. That is why the situation still feels dangerous to me even after the first big move higher. The market is not calm. It is suspended between hope and arithmetic. Hope says a deal comes. Arithmetic says a major choke point is still impaired. Traffic is still impaired. Inventory draws are real. And global growth plus inflation both become vulnerable. If this drags on, that is an ugly setup. And it gets uglier because the pain is not evenly distributed. Reuters reported that over 80% of the oil and LNG transiting Hormuz normally goes to Asia. ASEAN economic ministers and the IMF have both warned that the disruption can significantly slow regional growth and intensify energy insecurity. So the transmission is not theoretical. It is already showing up in growth expectations, inflation expectations, and policy dilemmas. That is another reason I think people are underestimating the secondary effects. They're still looking at the oil chart in isolation, but the oil chart is connected to everything else, to bond yields, to rate expectations, to consumer confidence, to transport costs, to margins, to fiscal balances in import-dependent countries, to equity multiples. That is why I do not think owning oil here is just an energy view. It is a portfolio view. And the portfolio view is simple if oil rises because the shock deepens. I want something in the book that benefits from the pain instead of only suffering from it. If oil rises enough to break the broader market, then gains in oil can become the dry powder that lets me buy the dip elsewhere. That is exactly the logic the source transcript was using when it said oil profits could be used to buy the crash. That is a much more serious idea than it sounds at first. It is not greed, it is hedged opportunism. Now, I also want to say something about history, because the source referenced 2008 and pointed out that oil once reached $147 a barrel without this kind of supply disruption. That comparison is emotionally useful, but I do not want to pretend price analogies are destiny. History gives context, it does not give certainty. What I take from history is not oil must go to X. What I take from history is that when the world becomes convinced supply is constrained and inventories are not enough comfort, price can move far more violently than most people think reasonable. That is the only lesson I really need. And I think that lesson is enough. Now let me tell you the clean version of my thesis. I am not buying oil because I know exactly where Brent will print next month. I am not buying oil because I am trying to beat the internet to some clever commodity trade. I am buying oil because, one, the Strait of Hormuz still matters more than most people emotionally register. Two, traffic and flows remain severely disrupted. Three, serious institutions are already documenting accelerated inventory draws and persistent deficits. Four, oil above $100 is already feeding inflation and narrowing central bank flexibility. And five, if this shock persists, the rest of a normal stock and bond portfolio can suffer in ways an oil hedge can help offset. That is all I need, not certainty, asymmetry. If the conflict cools and the trade hurts me, then the likely reason it hurts me is that the broader world is getting healthier, and the rest of my portfolio probably does better. I can live with that. If the conflict deepens and the oil hedge works, then I have protection against exactly the kind of environment that would otherwise do the most damage to the rest of the book. I can live with that too. That is why I think this is a rational hedge, not an ideological one, and that is how I want to leave it. This is not a normal oil environment. This is not a normal geopolitical environment. This is not a normal inventory environment, and because it is not normal, I do not think it is wise to pretend a normal, unhedged portfolio stance is automatically enough. Sometimes the smartest thing you can do is not predict the whole future. It is simply own one thing that can benefit if the future turns uglier than the crowd expects. Right now, for me, that thing is oil.